So how are private equity, other than the cash, bringing you a lot of money, how are private equity firms most helpful when they invest in a franchisor?
They're helpful in a couple ways. They are very strategic, and they will look at a business in a way that that founder may not have looked at the business before. There are almost always nuggets where they could say, well, gosh, have you thought about doing this? Have you tried this? Where the team either hasn't thought of it or didn't have the capital to pull it off. So, for example, adding a day part. You're only open for breakfast and lunch. Should we add dinner? I don't know. So private equity is good at asking those kinds of questions, helping them roll out new products, get into new markets. But they run a pretty clear playbook.
Welcome to the Franchise Hot Seat Podcast, where we talk about all things franchising. Now, here's your host, Dr. John P. Hayes.
My guest is Alicia Miller. She's the founder and managing director of Emergent Growth Advisors in Columbus, Ohio. Focuses on franchising and private equity. I think of you, Alicia, as the go-to person now on private equity and franchising. Alicia wrote this book, Big Money in Franchising, and I'm going to go on record before we get into the nitty-gritty of my questions saying this is one of the most valuable books I've read on franchising. I think it's very important for people to understand, particularly if you want to understand how private equity is a force in franchising and what private equity players are thinking about franchising. Whether you're an emerging franchisor, established franchisor, or you're a franchisee, this is a book that you need to read. Congratulations, Alicia, for this well done, well documented, interesting book, college level content. You got lots of far more facts and figures than my mind can deal with, but necessary to be there. Good franchise history included, insights, stories, and examples of PE and franchising currently, which is very much needed. So let's start right off with, if you were to give us the best example of a franchise company that everyone knows, but it's because of private equity. Got one in mind or a couple of them in mind?
Sure. Yeah. In the book, I talk about Tropical Smoothie. I think that's a great example and
Good one.
timely because they just traded again to Blackstone. This was a brand that did very well on its own. It built up 315 units, which in franchising, even that is pretty unusual. But in the restaurant sector, that still, is a subscale brand from a supply chain perspective. And their first PE transaction was to two private equity firms that specialize in helping emerging restaurant brands. And they grew them to about 800 units. And then they traded to a larger scale player, Levine Leichman, and then they traded again when they hit 1,400 units to Blackstone. It took them 15 years on their own to get to 300 odd units, but in the next 12 years, they grew to 1,400. And during that period, AUVs more than doubled. So franchisees continued to do well and continued to come back and buy more units. So I think it's a great story of how working with the right partners can really accelerate the brand.
My introduction was in about the early 2000s when the Dwyer Group was a publicly traded company and I was on the board of directors. Don Dwyer, unfortunately, had died unexpectedly, only 60 years old. Fortunately, had a terrific family that he had brought into the business, 6 children, and at the time, at least 4 of them were very involved. Dina Dwyer Owens, then becoming the CEO, succeeding her father, did a magnificent job. But it was part of ego for Don, and I'm not saying that in a bad way. Don was my mentor and friend and one of the pioneers in franchising. And so many people today would not be in business or be well off had they not met Don Dwyer or acquired one of the, at the time, maybe 9 franchises franchise brands that we owned. But being public had a lot of downside to it. And selling to private equity made a lot of sense, even though we were in the early track. 2003, I think that deal was finalized with Riverside, who ended up selling them and buying them again and selling them. And of course, today Dwyer is known as Neighborly. It's not a brand name like Tropical Smoothie that everybody would recognize, but for home services, it's the giant. And private equity has made that possible, and a lot of intelligent, hardworking people as well. And this is going to happen for other companies in franchising. You point out that, I don't know if this is from the beginning of time or from the beginning of private equity, 700 franchise brands have partnered with private equity companies. And of course, there's more to come. You point out private equity has at least $2 trillion to invest in franchising, or could be invested in franchising. What's this all about, really? Where'd this come from? And let's talk about if you're a franchisor or a franchisee, and why would you utilize private equity money? How would you utilize it? How do you know if you're qualified to get it? So let's start with right from the top. How long has private equity and franchising been around? Where did it come from and why?
That's a great question. It came in around the 1990s. A few firms in private equity had some experience in malls and, some restaurants and exposure there, and understood that sector and started making some bets in franchising. But the three deals that really got everybody's attention were all from Bain. They did $5 billion of acquisitions, Domino's, Dunkin', and Burger King. And they made a really great return for their investors and moved those brands forward in a meaningful way. And it's like the entire industry all of a sudden said, aha, franchising, what a great model. This is a really great business. And more firms started coming in. It really accelerated, though, after the financial crisis. So starting in 2009 is when things really started to heat up. And it's simply that, the private equity industry continued to grow and more funds were being set up, and investors were looking for great opportunities to invest. And, the example that Bain set showed that franchising was, a great business that had been around for decades, thank you very much, without the help of private equity, and did just fine. But at that same juncture, going public looked in some ways less attractive for many brands. And as you point out with Dwyer, some that were already public decided, this isn't really working out the way we had thought it would. Let's go back and go private. Well, private equity, that's what they do. Take them private again and can continue from there. So kind of all of these forces came together at the same time to get a lot of people into private equity sort of all at the same time.
One of the challenges in a publicly owned franchise company is that the board of directors is always looking out for the shareholder, or Wall Street, or the street. That won't be good for the street, someone would say. Shouldn't we be doing what's good for our franchisees, which is what a privately held franchisor is able to do? But in private equity, is a problem going to be, well, the private equity folks aren't going to like that decision we're making to revamp our technology at $2 million. It's for the best for our future and for our franchisees, but is that where do you have a conflict of interest?
Well, not if you believe that the best way to grow a franchise is to have satisfied franchisees. If you want to continue growth, you've got to invest in the future. Things change and you need to upgrade technology and keep the menu fresh, or, whatever your product and service mix is. Private equity has moved brands forward when they keep that in mind, and you can see it in the results. The results don't lie. But when brands stall out, a clear and common problem is that they've lost that focus on that simple franchise best practice, which is franchisees need to be satisfied with their investment, or they lose their enthusiasm for growth. And then you cannot convince entrepreneurs to invest more money in more growth if they're not on board. So you will have to stall out if you don't keep it in mind.
Yeah. So who are these companies? You mentioned Bain, one of the big ones, but should we be thinking these are Wall Street companies, or are they spread across the country? How many of them are there, and what do they represent? What's this all about?
Sure. There are 5,000 registered private equity firms in the United States and thousands more family offices. So There are lots and lots of players here. And in my research, I counted 400 private capital firms have already made investments in franchising. So still a really small number, and many more firms have yet to discover franchising. I think we can anticipate more coming in. There's certainly a lot of money sloshing around that needs to get invested. So we'll see more coming in, but they're all different flavors of mandate. And that, in the book, I kind of lay it out in a way that makes it easier for people to think about where their own brand is in its life cycle, and therefore what kinds of players might be interested in investing now or in the future. And I think that makes it easier to chunk it down and for people to digest sort of where those players are coming in and why.
So not all private equity companies invest in franchising. Some are investing in other, like insurance, for example. But you say at least 400 have invested in franchising. And do they have preferences? So will some of these companies only buy retail, or some only want food, or some want only the home services? Do they specialize, or are there some that, if it's a good company, makes sense, they want to invest?
Yes. I think private equity right now as a group has really embraced specialization, not generalization, as a way to get outsized returns, because then they can deeply understand a sector, whatever that sector is. So folks who are very active in franchising have set up dedicated funds like Riverside to go after specific, franchise only investments. And some will specialize more deeply in, say, food or not food or home services. And then in addition, some will specialize in only emerging brands, and others prefer to see more scale and won't touch a brand if it's got less than 2 million in EBITDA, right? So they self-organize based on what they're looking for, what their mandate is, and what they feel they're good at. And they tend to stick to that.
And how does this work? That, first of all, no one knows how many franchise brands exist in America. There's no government ruling that says you got to sign up and register here. So it's a guess. We say, FranData, the International Franchise Association, others will say there are about 4,000 brands. There's a new one every day, about 400 a year, which means that 400 a year must be disappearing as well, because we've stayed at 4,000 for a long, long time. But nobody really knows. And then how many of those are actively selling franchises? How many of those are national? It boils down to maybe a couple thousand brands, or maybe 3,000. No one knows for sure. But you could find out, I guess, because you did, where all these private equity firms are. I'm wondering how these two worlds how these two worlds come together all the time. That suddenly we hear, hey, so-and-so private equity bought such and such franchise that we never heard of before. Do franchisors go hunting for them, the private equities, or the private equities out hunting for these brands that they want to invest in?
It's the latter. Private equity firms are pounding emerging brands that they feel that they've got some interest in. That doesn't mean they're planning to do a deal. It just means they want to learn more. And unfortunately, if you're an emerging brand and you've just launched your business and you've only got 10 or 20 units open, you probably are going to start getting some exploratory calls and emails. But you're probably not ready yet to trade or to bring in private capital. And you can waste a lot of time talking to, different financial firms before you're really ready. And if you don't have your ducks in a row and are well prepared for those conversations, you can actually do a little bit of damage about how the market perceives you, because all these brands talk to each other. So you've got to make sure that you approach those conversations in a very professional way and are ready. Otherwise, you're literally part of their fishing expedition, and you're probably not going to get out of it what you want. In most cases, founders are really just kind of curious about this private equity world and kind of curious what their company might be worth.
Yeah.
And so that motivates them to start the conversation. And then one thing leads to another, and before they know it, they're owned by private equity. Like, Okay, well, now you've got a boss again. Is this really what you wanted? You got to really think about it before you go down that road.
And franchisees get spooked because they like the founder. They've developed a relationship from day one with the founder. Suddenly, private equity is in charge, and the founder is still there, but maybe the founder doesn't have decision-making authority as he or she once did. So franchisees they have feelings about this as well. They're scared usually.
Yeah, but they really shouldn't be, especially in that first transaction. I think it's clear that the biggest lift in brands is in the first couple of transactions they do, where they transition from a founder-led organization to a professionally managed and backed with capital organization, because the agenda of the franchisee and the agenda of the growth-minded PE firm are fairly well aligned, right? They want growth, which means they've got to invest in infrastructure and support and potentially the tech stack and so on. So all of those things are good for franchisees. It's later on when the brand gets scale and those obvious growth opportunities are less, are something that's harder to get. That's when you start to see new fees layered on and new suppliers being required and such like that, where they're starting to tweak the model to try to improve the margin at the parent level. That's when franchisees start getting pretty antsy. And by that point, later on, it's also when the founders usually exited at that point. So that there's a big cultural difference once it's a more mature system.
So you say particularly that the first transaction or two, and you say it in a way that sounds like, well, if there's one transaction, there are going to be multiple, like Dwyer being sold and being rebranded as Neighborly, and I think 4 or 5 times. There have been 4 or 5 transactions, Riverside being 2 of them. Is that always the case? Is there a private equity who comes in and private equity's goal is not to hold the company? Is that what we need to get at and understand? They want to build it, sell it within 3 to 5 years.
Riverside was in Neighborly, I believe, 3 times. But for most PE firms, they want to trade. The average hold time is 6 years. And private equity research has shown that not even in, just in all private equity, not just franchise focused, once they're on this, what I call the PE profit ladder, they're going to keep retrading. That's just what happens because the first investor's got to monetize that by trading to the next investor, who then comes in at a different point in that brand's life cycle and has maybe different skills and can help the brand, get bigger or go international or, add new brands to the platform, for example. So there's lots of opportunities for the next buyer to then make a good return. But they will generally stay out of the public market and will retrade until they land, either they go public or they land with a long hold investor such as Rourke, right? Rourke does not sell a lot of brands. They like to keep them.
Okay. You said something else that is curious, that a new franchisor or any franchisor talking to private equity early on or maybe for the first time could do damage to their reputation because the private equity firms talk to one another. Why? Isn't this aren't they all on their own little hunt and they don't want anybody encroaching on what the gold mine that they're discovering? They want everybody else to stay away. Well,
true. But if they do their research on a brand and decide to pass, then they're no longer interested. So, they won't share confidential information. But, if I call my friend John Hayes and say, John, I'm looking at brand XYZ. Have you ever looked at them? What did you think? And John says, yeah, we looked at them a year ago. We just felt that it wasn't quite the right management team and we weren't so confident in their model. So we decided to pass. Mm-hmm. That's what happens.
That then could do damage to the opportunity.
Yeah, because everybody wants to be the one that found the gem that nobody else got. Right. They don't want to buy a brand that others have passed on. So they do a little bit of research on that. Mm-hmm. If you're going through a formal auction process run by a banker, now you're in competition and everybody sort of knows you're in competition. Mm-hmm. So that's a different game.
So another thing that is maybe the negative side of private equity, or some people say that it can be. Most franchise companies in America, and this is surprising to everybody, but nobody knows anything about franchising truly. I mean, it's only, we've always had somebody teaching a franchise class as an elective at University of Maryland or somewhere. But today with Titus Center, with the Yum Global Center, with other centers popping up at universities, we're actually teaching franchising, which franchising should have insisted upon 50 years ago, but I'm off on a whole nother track. This is one of the negatives that people say, well, most franchise brands never reach 100 outlets. And until you get to 100, you're really not able to sit back and be comfortable financially. As you're not making any money off 10 franchisees, 30 franchisees, 50 franchisees. They're keeping you busy, and you're constantly needing the royalty dollars to reinvest. Hard to get ahead. So most never get to 100 outlets, and that seems to be the magic number for PE companies. So today, there may be franchisors in that emerging mode who will do anything possible, anything they have to do, including selling these packages. You got to buy 3, you got to buy 5, because the emphasis is on let's get to 100. When we get to 100, private equity will pay, and we'll hit our gold mine, the founder might reason. What do you think about that?
Well, you need to do the math and make sure that's really the outcome you want. Let's unpack it. You can race to sell a lot of units through outsourced sales channels, and you can pay a lot of commission to do that. And you will field strip your own EBITDA in the process. So the buyer will buy based on a multiple of your corporate EBITDA. But if you have no corporate EBITDA because you've spent most of it on commissions, then their multiple will be lower. Even if they give you credit for some of those units being open, you're still getting less for the company than you would have if you had opened 100 units in a more modest fashion. That's just the math. Now, the worst scenario is you sell, I've been talking to somebody about this recently, 100 units sold in the funnel, 20 or 30 open, they're out of cash. Now what do you do? Because you can't get a bridge loan, you don't have any assets to get a bridge loan against. Private equity considers you unproven still, and only someone who is comfortable taking on a project in process, really, will be willing to buy you, and they're not going to pay very much for that because you have starved the company. They're going to have to come in and add staff and add to the tech stack and add marketing and so on and so forth. And their business case, they're not going to pay you as much for that company. And that's if you make it. If you don't attract a buyer, now you're stuck living with what you've created. And unfortunately, I think a lot of brands kind of land here and stall out because private equity, it's not like a bank truck is rolling up to fix your problem. You've got to, get those units open on your own. And it's very sobering for founders when they start meeting with private equity firms to get that message. And even the bankers won't take their case on because the banker's not convinced that he or she can create a market for that offering. So everybody says, we're going to wait a year, get them open. And now you have no money to get these units open with. So what have you really created there? Probably not something great.
Yeah. As it relates to selling franchises, what's your advice to a franchisor on how to sell franchises? Should they be doing this internally to protect EBITDA and not pay out those enormous commissions that we sometimes hear about? Not that they're not deserved, because these folks are working hard to get somebody to buy 3 or 5 or whatever it might be. So how do you advise a franchisor to get those first 30, 40 sales and get units open?
Yeah, those outsourced sales channels are really important to emerging brands. So my advice is get the first 5 or 10 units yourself, because those 5 or 10 franchisees need to be very carefully screened by you, and those are your validators, right? They've got to show If you're selling with an item 19, they've all got to open and be successful, and that really builds the foundation for the business. And then you can bring in outsourced sales channels to, light a fire under this thing once you've really solidified what you're selling. If you have one corporate unit and you put up the flag that says we're selling franchises now, you just really haven't proven out the model. And so now the clock is ticking. And if you start selling a bunch through outsourced channels, you've got to get all those open, or you don't look like a real business.
Some of these emerging franchisors, I meet them at franchise expos all the time. I meet them through the Titus Center. Some will inquire about speaking to my students or coming onto our advisory board. Their problem is they have a good business corporately. They've run a good business. They don't know how to sell a franchise. And they will be at franchise expo after expo after expo talking to people. And in 2 years, they've sold 2 franchises. What's wrong there? What are we missing? What do they not understand?
In my experience, there's 2 types of franchise founders: the operators and the salespeople. So the operator is the person who has a great restaurant concept or a great home service concept, and they really are deeply steeped in whatever that is, the wellness industry or whatever. And they run a good business, and people start saying, this should be a franchise, but they don't understand how to sell. Then the other group is the group that really understands sales, down to their fingertips, but don't have the operating model honed. And that, to me, is a more dangerous combination, because the operating model has to be right for franchisees to make money. The operator can always find outsourced sales help or fractional franchise development assistance to help teach them the right process to build up your franchise sales. The other way around, I think, is actually a harder thing to come out of.
Mm-hmm. I wonder if private equity has created a scenario in which we have people deciding to franchise their business who would not have done so had they not dreamed about the big buyout that they read about from private equity. So in a sense, is private equity hurting franchising by creating false hopes for people? Not everybody should and not everybody can franchise a business.
Agree. Yeah, I don't think private equity is the one sending that message. Their message is pretty clear. We do not buy troubled brands. We do not buy turnarounds. And we really are not here to fix your problem. Private equity is not the one setting this wrong expectation, because they're very clear. They say, we don't really buy turnarounds. We're not here to fix your problem. We want to accelerate a proven model with a great management team. That's what we want.
Yeah.
So they're not the ones setting this tone. It is the industry that sells franchises and helps launch franchises that has set this expectation, I think, wrong. Because a founder who's been running their restaurant and has 2 restaurants open has no idea what private equity is in franchising. They're not exposed to that. They get exposed to it through the process of exploring whether they should franchise their business. And then they ask, well, what's the end game here? And the consultant says, well, there's a lot of private equity activity. Someday down the road, you can get yourself to 100 units and get bought out. And they say, great, show me how to do that.
Yeah.
So I don't think it's private equity setting this expectation.
Mm-hmm. Yeah. How often are private equity companies interested in multi-unit franchisees? So instead of buying the brand, they'll go look at this franchisee who owns 88 units of something. Will private equity pursue that, or is that not of their interest?
They will. Yeah, there are some firms. Most firms make a decision pretty early on. We're either going to invest at the brand level or the franchisee level, right? That's a pretty hard cutover where they make that decision. But there is a lot of private equity activity in large scale mature brands where they are consolidating because of all the same things that you find at the platform level. You can also get those same synergies at the franchisee operating level. You can build a strong team, you can build a great bench, you can give career opportunities to people where, you've got that you can't provide if you've only got 5 units of a franchise compared to 50, right? There's just more opportunities for your team. It helps lower turnover, and you become a better operator as you hone your systems. Your voice also gets bigger because you own more units within that franchise system. And it doesn't hurt to have the extra capital backing you when you're, acquiring units that already exist and then building out new territories. So some systems have decided to let PE in at the franchisee level, and some systems are more than half owned by PE at this point.
Mm-hmm. And if you're an emerging brand, at what point will the private equity folks pay attention to you?
Well, the group that likes emerging brands, you'll start getting phone calls once you've proven yourself. So 10, 20, 30 units, you'll start getting phone calls. Some of them are willing to dip into brands that have less than $1 million of EBITDA. It's a pretty small group that's willing to do that. Most would prefer to see you above 2 and ideally above 5 or 10. Mm-hmm. So again, it all depends on the buyer and what their appetite is, and what, a large fund cannot write a small check. It's just, it's not practical for them to run 50 investments out of one fund. It's just too many. Mm-hmm. So they prefer to write bigger checks. They prefer you to be, wait until you're bigger.
So we hear a lot about the multiples that private equity pays. It's been in the teens, not always there. But is this unusual? Is it unusual that you're going to get a multiple of 12 to 18 from private equity?
It's not unusual, but I think those multiples have dropped recently. Buyers and sellers are still pretty far apart. And, sellers are still remembering 2021 when things were a little nutty. And, if they didn't pull the trigger then and they're now looking, their expectations are probably a little high compared to what the market's willing to pay. Interest rates have gone up. And, there's not a lot of debt put on an emerging brand, and sometimes not at all. It still affects what a buyer's willing to pay.
So, as you and I would agree, franchisors and franchisees are not created equally. Some are better than others. And some franchisors don't really have a system. And to me, if you don't have the system, don't buy. If there's no system, don't buy, because there's no business, there's no franchise. That's hard to drill in to people. Some franchisors don't have a real system or a complete system because they don't have the money to do it. And they might need private equity money to build that out. Is private equity interested in coming in and saying, okay, we can help you build the rest of your system?
Not really.
Yeah.
It's too small. It's too small and unproven. They're not risk takers. People don't understand that. Private equity, these are not, swashbuckling risk takers. They have a mandate. They've got to return money to their investors in a fairly, finite amount of time. And they need a more sure bet. It's not venture capital. The only group that's, there's a small group of investors who are willing to bet on emerging brands, but they're picky. They're not picking up all of them. There's literally thousands of these little brands available, mm-hmm. right? That are under sub 30 units, sub 50 units. There's plenty to pick from, and they're not all getting picked up by private equity. That should tell you that there's just not a lot of there. So, like I said, no one's going to bail you out. The better path would be for an emerging brand is open a few more corporate units, get some cash flow to help you staff your team, right? Mm-hmm. If you've spent every penny you have launching the franchise and you have one corporate unit, you don't have much to work with.
Good point. And, I sometimes wonder, and I teach franchising. I'm a proponent of franchising, 40 years in this. I've been a franchisor, a franchisee. I love franchising. I think that's the way to go if it's for you and it's not for everybody. What bothers me today somewhat is that, wow, do we really need another brand in that niche, whatever that niche might be? I don't want to mention any because I don't want to offend anyone. But wow, are we getting to a point of saturation? Are we getting to a point of we've over-franchised in this category? We really don't need more of these, or is this that's not the free enterprise way?
Yeah, I don't know. it's still a very fragmented market. I remember seeing a stat from one of the M&A advisory firms that there's something like 13,000 air conditioning and heating companies in the United States, franchise and
You
non-franchise.
can't get one in Florida.
Yeah, I mean, it's just a lot of these sectors are just very fragmented. But
Yeah.
I think your point is spot on. When an emerging brand wants to bring itself to market, how are they going to get the message out to potential customers? It's crowded and noisy. Marketing is expensive. They've really got to think through, are we creating enough organic interest in our own market where people are bugging us asking if we're a franchise? If nobody's doing that, and you've got one or two units, so that's something to think about before you try to launch the franchise.
And that's not something that you can depend on private equity to help you do, to figure out your marketing system.
Nope.
People make that mistake. But so how are private equity, other than the cash, bringing you a lot of money, how are private equity firms most helpful when they invest in a franchisor?
They're helpful in a couple ways. They are very strategic, and they will look at a business in a way that founder may not have looked at the business before. There are almost always nuggets where they could say, well, gosh, have you thought about doing this? Have you tried this? Where the team either hasn't thought of it or didn't have the capital to pull it off. So, for example, adding a day part. You're only open for breakfast and lunch. Should we add dinner? I don't know. So private equity is good at asking those kinds of questions, helping them roll out new products, get into new markets. But they run a pretty clear playbook. So you can, based on where a brand is at that juncture, you can kind of bet on what their initiatives are going to be. They're going to try to accelerate franchise development, sell more units. They want to get them open, so they're producing royalties. They're going to add staff to make sure that franchisees are supported. They're going to try to get into new markets. They might add new services, new products, and they're going to try to accelerate the brand in that way. So you can kind of tick through their list of their playbook and anticipate what they're going to do. And it's a combination of bringing the right capital and focus, and also being able to recruit the talent to do it, right? If you're an emerging brand with 10 units, you're going to have a hard time recruiting that really solid, proven management talent. Is going to wait until you're more of a sure thing or a bigger company before they jump. And you're seeing a lot of movement right now. There's a lot of people changing jobs, and being able to attract that caliber of talent takes a while, and sometimes it takes a private equity firm to pull it off.
Does private equity have an opinion about absentee ownership of franchising?
That depends on the brand. I think in general, they prefer to work with engaged franchisees. So it doesn't mean they have to be in the business every day, but certainly if you're absentee, then there needs to be some operator helping you run the business. And there's ideally would be some sort of financial stake that operator would have in the business, so they're motivated to stay.
There was a time in my lifetime in franchising, and guys like Don Dwyer and Bill Rosenberg, founder of Dunkin' and founder of the IFA, they, I would imagine, roll in their graves when they hear some of the absentee, semi-absentee owner pitches that we hear today. It's frightening. They would have never permitted that. This was a hands-on, you're going to give up your job, you're going to devote yourself 1,000%, and this is your future, this is your livelihood, this is where you're going to make the most money. But today we have a pretty good push on absentee ownership in franchising. Is this, what do you think? Is it going to be good for franchising overall? Guarded about that? Or is this going to be a disaster, as some people have said?
I think it depends on the operating model. If you've truly set it up so that a manager can run it and you don't have to be in the business every day, that's fine. But I don't know, in my experience, and it sounds like yours as well, that active owner just is better at running their business. And you've got to be somewhat hands-on. I would be very scared as a franchisee to come into a system that said, oh, you can just run this absentee and it's very hands-off. That just doesn't sound realistic to me. Mm-hmm. So the question is, who are they trying to recruit? Are they recruiting somebody who understands business, or has an idea of what it is to be a business owner that's just wrong. Because you do have to, every now and then you're going to get a manager who doesn't show up. What are you going to do? You're going to have to leave your job at the accounting firm and go show up and do the shift because you don't have the person there. I mean, that stuff happens when you're running a business, and you're setting the wrong expectation if you say it's 100% absentee. There are some new brands launching that have you launch the business and then you hire them as a management firm to run it for you. Okay, right. Well, that's a model I don't know that I love, but it's out there.
Yeah, it's going to be interesting to see how these new models develop, and good for franchising and that people are experimenting, but bad for the people who are potentially will lose their life savings and go into debt. So this is something we've got to be cautious about. I tell my students that all the time because I don't want them to get the idea that franchising is great absentee fertile ground. It just has not been historically. We'll see how that goes. One of the things about private equity, and I loved Riverside and still do love Riverside, know some of those folks, but I don't have any close association with them. Riverside invested in Dwyer and came in and asked questions and provided direction, but did not replace the management team. Added to the management team at some point, but the Dwyer family remained very strong for a long, long time throughout that relationship. It was not until Mike Bidwell, who was really almost family because he was Don's franchisee out in Arizona, who was ready to give up his franchise. And Don saw he had more potential and said, move to Waco and become the president of Rainbow International. And Mike did do that, and then Mike grew up through the management team and succeeded Dina then eventually. Of course, it's now the late Mike Bidwell, unfortunately. But Riverside never, I wouldn't say they ever interfered. So franchisees never felt threatened. Franchisees, particularly if Dwyer had 1,000, more than 1,000. I don't know, I don't remember the exact number of all 9 brands at the time. But when you have that many franchisees, franchising is a relationship business. When I was the CEO of HomeVestors, there were people who never called with a problem, but called with good news or to have dinner or how are you doing? You develop relationships with these folks. What franchisees fear is I won't be able to talk to you anymore. I'll be talking to somebody from private equity who doesn't know anything about me or my family. That doesn't seem to be the case, though, from what I can tell. And I don't know enough private equity deals. I know numerous private equity people, including several on my advisory board. But I don't think, is it a fair complaint that franchisees should be fearful that, well, I won't be talking to the founder anymore or anybody who I've known there. I'll be talking to some stranger, not even where the franchise is headquartered.
Sure. I think it's a valid concern. I get it. For franchisees who come in early, they have a really strong bond with that initial team that got the franchise launched, and they sort of worked through the kinks together. But as the brand scales, it's not realistic to think you can just pick up the phone and call the founder when there's now 500 units in the system, right? So you have, before they could just pick up the phone, now they've got to submit a help desk ticket. And it feels very sterile and
right.
That they're not important anymore. But that's just part of the evolution of the brand. That would happen with or without private equity if the brand was scaling and doing well. Those layers get put in place. Private equity prefers to back good management teams because they're not operators themselves.
Yeah.
Unless they're an independent sponsor and they're coming in to run the business, they want to back a good management team. So the complaints can go either way, right? So a franchisee might feel, well, gosh, I'm talking to a new management team I don't have a relationship with, but they can be equally ticked off if the sponsor isn't doing enough to make sure the management team is doing the right thing. If they're too hands off, that can happen too, where franchisees complain and say, look, we need to take price, we need to raise prices here, for example. And the franchisor might stall out and say, no, we're not really ready to do that. We want to test it some more or whatever. And the franchisees can get frustrated. and they feel that the management team isn't doing something that they want them to do, they can try to escalate it to the PE firm. PE firms usually don't like that. They don't want to manage the business. They have a management team for that, right? So franchisees can get frustrated in both directions. But it really comes back to what kind of relationship are you building with your franchisees? And do you have a mechanism to manage through change together? Because you're going to need to manage change. So how do you do it, and how are franchisee voices incorporated in that?
Some critics say that the real winners, big winners, only winners, are the founders who receive private equity money and their partners and management team. Is that the way it's working?
Well, there's certainly a lot of money to be made if done well, if done right. But there's plenty of founders who make missteps as well and get bad advice or don't listen to good advice, or don't follow franchise best practices, where they don't really make as much money as you would think. If you go back and look at disclosures, you can see in many cases what that guy got paid for that business. And if you assume that, let's say you sell it for $10 or $15 million, by the time you pay off your debt and your other investors, your angels who helped you get started, your friends and family, you may not have made all that much money in the end. So a lot of these emerging brands, they go on a circuit and they talk about, you founded this XYZ brand. You got to dig into the details to find out how much they really made. Some have done phenomenally well, but mostly because they built a really great system that benefits their franchisees.
My guest has been Alicia Miller. The book is Big Money in Franchising. I love that title. I wish I had written that. Wish I'd come up with something like that. But you did a great job on this book, Alicia. Anybody who's serious about franchising, who's serious about building a franchise as a franchisor, and has some idea about, well, maybe one day we will cash out, you need Big Money in Franchising. Go get it. And thank you, Alicia. This was very insightful and very helpful. I appreciate it.
Thank you, John.
Thanks for tuning in to the Franchise Hot Seat Podcast with Dr. John P. Hayes. Tune in next time for more conversation around all things franchising.